Howdy traders, Mark here with Flipside Trading, and I just want to take a couple minutes here to talk about the market performance last week, and more importantly, what's on the horizon for next week. And the key things are we have a number of events. Number one, we have a very heavy earnings week with almost 20% of the S&P 500 reporting. Number two, we have an FOMC meeting, and we're really going to be all ears on whether or not they're going to continue to reduce the repo funds that they've been injecting to the market, i.e. the faux QE4. And the coronavirus, it's definitely its expansion to China and the rest of the world, and how that may affect the global economy and ultimately the global markets. So without further ado, let's jump into the charts. Let's see here. Okay, what we're looking at is a chart here, a daily chart, the S&P 500, based upon the SPY ETF. You can see that we've been moving up with the ADMA, this yellow line here, serving as key support. We finally broke that on Friday due to some repo numbers as well as the overall onset and growth of the coronavirus. We're still stacked from the moving average perspective. Right, our 8's on top of the 21, on top of the 50. We're above daily value. You can see here that we're still above zero for momentum. But we have crossed finally from the oversold value, which is potentially a good thing, right? The market has been really working on this almost exponential euphoria, kind of straight up here, and the markets don't move in a straight line. So it would be healthy to have some type of a pullback, either to the 21 EMA or maybe even top of value before potentially expecting moving up. So at this point in time, as we talked about before, it has not been a good time to add to the markets given the height of the all-time highs. We have been waiting for a pullback, and the pullback may present another entry, but we'll have to wait and see and monitor that situation as the data comes in. We also want to take a look at the other asset classes here. Let's look at the NASDAQ and the other index. You can see the same thing. We have our moving average stack. We're above value, and the ADMA has been, key. You can tell that we haven't fallen nearly as far because a lot of the earnings that are reported next week are in the tech sector. And again, we have not come through from the RSI. We're still in an oversold condition, and we still have momentum going up. So potential positives there. Unfortunately, the IWM, which is small caps, which has usually been considered a leading indicator, has not served as such, in the sense that it's not a leading indicator, at least in this perspective. We came up here, we hit this the pink line, this VPOC, the volume point of control, and it was firmly rejected. Not only was it rejected, we actually fell all the way back into value. So now the question is, will the bottom of value hold in conjunction with this 50 EMA? Or will it continue to pull down? If it does continue to pull down, it probably will weigh on the other indexes as well. Let's put this in a little bit of perspective, and let's kind of look at the weekly. And let's look at the weekly of the SPX real quick. If I could type, that always help. And we come up here, and we'll move over to the weekly charts. Let's see, here we go. So on the weekly chart, you can still see that we are firmly within this channel. So there's no alarms as far as any imminent decay of what's happening. We have both the ADMA and the bottom of the channel here, which should provide some decent support as a pullback and as potentially a buying opportunity. But we definitely want to see some type of bounce off of this to happen. What we want to look at here, and I'll show you a chart in a minute, is that we have seen repo reductions, i.e. the amount of money that the Fed is actually contributing to the market as far as buying treasuries and swaps. And every single time that the Fed has gone ahead and reduced those repo dollars during the week, we've seen this reduction. And so obviously the market is a complex being, but just knowing that here we are in the midst of this huge up channel, and we have these repo reductions that it's definitely affecting the market. So the question is, if the Fed ever does pull their support away, potentially it could be a very adverse effect for the market. And let me kind of look at it here. Let me get rid of these screen draws. So if you come here and we take a look at this chart, what this chart is showing in the blue line, this is all the assets that the Fed is accumulating. And you can see that, we're starting to we had an elbow here, we had another drop here, we're dropping down here. These are the assets that, from, the repurchase agreements that are happening. You saw that's also, hitting this downward slope, and this is the total assets themselves. So you can see that there is a direct correlation between when we have these drops and these peaks and valleys. As we showed you before, we're getting those semi-reductions or pullbacks, or at least some pause in the upper climb in the SPX. So the question is, on Wednesday at noon Eastern, we have 2 o'clock Eastern time, we have the FOMC meeting. So everyone's going to be listening hard to see what Chairman Powell has to say about the rate and consistency, or definitely the duration of what this repo infusion is going to look like. Obviously, if he comes across in a dovish manner and says we're going to continue, then I would expect the markets probably to move sideways to up. Obviously, if he hints at reduction or any type of reduction schedule, then at that point in time, I would definitely see the markets not reacting favorably to that news. So that's going to be key in context as we look at our credit spreads going forward, as placing those on Tuesday night going into Wednesday. The next thing we want to take a look at while we're here is we talked about earnings. And earnings next week, we talked about the S&P 500. The S&P 500 is broken down into sectors, as you can see here, from technology all the way down to telecommunication services. And you see that technology, of course, has kind of the highest weighting. In addition to that, next week, here are the top 10 components of the S&P 500, representing almost a quarter. 7 out of 10 report next week. Apple, Microsoft, Amazon, Facebook. See, Berkshire reports February 20th, I believe. You have both your Google classes. JP Morgan already reported. Johnson & Johnson reported, and of course Visa reports this week as well. So depending on how these earnings come out, and I think that there's 2 key pieces on the earnings. One is going to be, did they beat from a earnings per share standpoint? The next thing is, and that's always these days a little bit of I'll say a false positive indicator because of so much of the share buybacks, from the dividend perspective. I think that the key numbers really to watch are going to be more on, did they increase in revenue? Did they hold margin? And lastly, did they, my mind just went blank there, pardon me. What is the overall outlook? Okay, there you go. So those are the key 3 factors. So just because you get good earnings, if you don't have those other 3 factors, i.e. growth of sales, i.e. good, your maintenance and margins, and your outlook, you can see this potentially, dipping on the market. Now, Apple starts on Tuesday night, and then I think Wednesday and Thursday are the other big nights. They're all after the market closes, so we'll have to be watching those. So what this means is, going forward, given these increase in volatility events, is you really have to consider, number one, potentially reducing size, or if you're nervous about these things, because they are, if they're one-time, binary events, right? Did you get it or did you not? That result in market spikes. Don't be afraid to sit it out and sit on your hands. Sometimes the best trade that you take is the one that you don't. So keep that in the back of your mind as we go forward. And the last thing we want to talk about is the virus itself. Now, look like here, this is a great map of the virus that I've posted to you guys on the Twitter account as well. But you can see, number one, your confirmed cases. We've got this hockey stick going on in place down here. And this hockey stick is really what has people worried. And the reason it has people worried is a number of reasons. Number one, right now there's over 40, somewhere between 40 and 50 million people in China under quarantine. They're actually doing aerial spraying. It looks like crop dusting. People are in basically hazmat suits, walking around towns. They're starting to, run out of vegetables. And what makes this virus so insidious at this standpoint is that it has basically up to a 2-week incubation period. Unfortunately, during that incubation period, you're also infectious. So you can walk up to someone, they can show no signs, i.e. fever or any any other screening techniques that they may be using at the airports to have you back and forth, that result in helping keep people from moving about and contaminating others. So now you have the potential effect for contagion to be high because it's very basically it's subtle, right? We don't really know who has it and who doesn't, and you can see it's starting to move over here to other countries. And the key thing is that when you have quarantine and when you start reducing the move of resources, well, that reduces the move of trade. And China, being the second biggest economy in the world, is basically on hold. They're almost on shutdown, right? All their huge Chinese New Year celebrations have been curtailed. Schools have been closed down to the middle of February. Factories are being closed because all these are congregating points for people. And of course, if there's nothing going on, then productivity drops. Drop in productivity then affects the economy. The economy then affects the overall future outlook in the stock market. So definitely, we'll be keeping an eye on this. And as a matter of fact, if we go ahead and take a look at what's happening, right now, let me jump out of here real quick. And let's go back to our charts. Let's go back to the futures, right? The futures just came on a while ago. I'm going to take a look at the ES, and we'll go back over to the daily perspective. And you can see here, looking up top, is that we're down almost a full percent. We're down 33 points, trading here at 32.60. So these things, with the virus itself, has definitely weighed upon and potentially uncertainty on earnings, potentially uncertainty in the FOMC, all laying a hand to this possible, pullback in the market. On top of that, there was the latest news that there were 3 rockets that landed in the green zone into the U.S. Embassy. Again, there seems to be a filtering as far as casualties. They happened last time, if you remember, initially that the State Department said there were no casualties, when in fact there were. Based on the report that there were no casualties, the market basically ignored that kind of global tension. I think the market has learned, and my gut feel is that this is definitely factored into that pullback. How far can this pull back from a daily perspective? Well, of course, we have the trend line here, but I would say at least on the near term, okay, and near term means, in a day or two, or how low this can go. If I take a look at, let's move these screen drawings. I take a look at the hourly drawing right here, and I take a look at, and I come down, and let's see. Okay, we have a nice VPOC plus this is our secondary pivot between the 32.42 and the 32.33 area. You also have this confluence here of last week's R2 as well. So this 32.38, let's call it the 32.42, is a key support zone. We'll be watching that to see whether or not the market reaches it, number one, and number two, whether or not it actually holds. Now, if it actually holds, then of course we'll have to take another look at the market and see, how much further it can fall real quickly. We take a look at that. The top of value would be all the way down to 32.06. That would also correspond with the 50 EMA. So, kind of to recap, then I would say that your 32.30 to 32.42 is support zone 1, and then your 32.10 is definitely support zone 2. So keep those in mind as you as we trade going forward. Again, be prudent. Volatility will kick up. It will give us, should we say, more cushion. However, that cushion with increased volatility, at this stage, means that the market can travel, 30 to 40 points, in a day. So even though you say, okay, my short strike is 50 points away, don't consider that a slam dunk no-brainer. Definitely consider, reducing size, because any one of these, should we say, news events could have a very impactful, detraction to the market. Okay, guys, there it is, short and sweet, right? Just keep in context for next week. We'll keep you posted via text, and we'll talk to you soon. All right, catch you on the flip side.